Hello, guys and girls. Welcome to this series. On this series, we are going to embark on our continuous backtesting and chart session where we kind of dissect the price action strategy that I use. I think this is going to be helpful for new and intermediate traders who are still kind of struggling with price action, or maybe perhaps still in the middle trying to figure out the best price action to use. So this one is a complete price action 101, which I believe that if you actually commit to this series and then you actually go with us from the beginning into the end of the series, however long it's going to take, I believe by the time you are done, you are going to be a better trader because on this series it's going to contain two phases. Phase one is going to be chart session or chart work, where all we just kind of do is talk about the chart pattern that we look for, the fundamentals, and then onto phase two, that's where we're going to go on a backtesting replay because phase one is just to familiarize us with the concept, with the strategy, the price action strategy, and then because this phase one is not going to be that kind of realistic in terms of real life market, but phase two is going to get us closer to that realism. But however, phase two is not that realistic because one thing about um, strategy is that when you are in the live market, the emotions and a lot of things, psychology is going to play a key difference in you executing it effectively. So, which is why onto the phase two, we are going to be considering a lot of variables in the market, and then we'll see okay what will be the best options in this kind of scenario, and then if it aligns with what we're looking for or what we've been testing. So this is kind of be where a trading plan is going to come, the kind of stuff that you look out for. I mean, a lot of things is going to come into play in this series. It's like that's why I want to take my time and then give you the best value that I can give you. This will be a kind of, I'm still in the early phase of my teaching stuff, so you're going to bear with me in terms of errors or mistake. Remember, I'm a human being anyway, so I don't think I'm going to deliver it in terms of the knowledge transfer. Like I don't think I am going to uh, um, be perfect in terms of the delivery. However, I'm going to do my best and make sure I give you the best value that I can offer. So one thing about strategy is that backtesting is that number one, you need to know why you want to do what you are doing. You get, and the reason we are doing this thing is to get familiarize ourselves with this price action strategy. This is a pure price action strategy. And then number two is what's the setup criteria? What defines the setup criteria? Because look, whenever you are backtesting or doing a kind of chart work, you need to be deliberate and intentional about what you are looking for. You don't just do it randomly and then you end the sessions and you think, okay, you know what, I have backtested or I have do some chart session. We need to be we need to be intentional and deliberate about what we're looking for and what we intend to achieve on the sessions, right? So the the thing that we are going to focus here on this question of what's the setup criteria is that we want it to be backed by higher time frame structure, and then we want price commitment or momentum in our favor, and then we're going to be utilizing 1 hour entry in this one. We're not going to go to 15 minutes. So, but the process is still the same when it comes to 15 minutes. However, we're going to stick to 1 hour in this phase or on this phase, and then the entry type, which is something I'm going to explain after this one. So that will be what we're going to be looking out for, and then the aim is to get familiarized ourselves with the this concept, like I said, and see how it works, so that we can actually backtest that in terms of the replay, and then before we can actually replicate that in the on the live market. You get, so the cons is that of this phase one is that you're probably going to see a lot of trades that work. On this phase one, a lot of things that you're going to see is going to be trades that work. You know, they said hindsight is beautiful. So it's going to be hard for us to detect those ones that doesn't work. which is why phase 2 comes into place, because with phase 2 you're going to be able to get those ones that work and this one that doesn't work, and then you can even out the odds, all those kind of net profits, net loss, all this kind of stuff. That is where it comes. But on this one, majority of the things we are going to see here is going to be those ones that work, which is something that we want to even achieve on this phase. So, and this one is not, like I said, it's not 100% realistic in terms of live market performance or execution. However, the aim is to get familiarized ourselves with the concept. So that is what we are going to be doing on this one. So without further ado, let's dive straight into episode 1, which is market structure fundamental. Now, here we have this is a picture of what we want a high time frame structure to look like before we kind of engage on the lower time frame and look out for setups that met our trading plan. So the first one is this one. This is a reversal structure where we have this first high, and then price make the low, make another higher high, make a lower high, and then make another higher high, and then it forms 1, 2, 3 structure, and then this is where we are going to be looking out for the sell. Once it makes the 3 touch, that's where we're going to be anticipating a sell to the downside. This will be a reversal structure, 1, 2, 3 ascending formation. Now this is another variables. This one too is a reversal structure, but this one is expanding. So we have 1, 2, 3, like I said, and then we're going to be looking for a sell from here. Now, what will increase the probability of this one actually committing to the downside? Now, the pattern in isolation, it works. It works where you have 1, 2, and 3. It actually works, but it is best if we have a kind of high, let's say daily or weekly high, supporting this pattern where we have something like this. Let's say we have a point of interest, and then we have this kind of structure leading into a high, a daily high, or weekly high, or 4-hour high, even sometimes 1-hour playouts, right? So once we have a high actually leading out to this kind of structures, this will be a high probability criteria for us to start looking for the sell, right? Once we see the commitment, that means provided other criteria are met. Now on this one again, it's still the same thing where you have the push down, and then you have this price push back up and then push back down again, where you have this one. So this one will be another area where we can look out for the sell again. Look at it. We have 1, 2, 3 into this high. Sometimes this one can actually plays out, but then that's where momentum or commitment comes into place, because before we actually engage in any position, we want to see commitment in the directions that we want. Then we can now evaluate it in terms of our trading plan setups, and then if it meets the conditions, we are going to take it. Which means because price is here doesn't mean you're going to sell right away, or because price is here doesn't mean you're going to sell right away. You still need extra confirmations, solid ones, before you actually engage on the position. Some people do take it risk entry at the top here, but for me it's not something that I find success on, so which is why I don't take that. I only focus on continuation. Hence why on these sessions and beyond, we are going to be focused on the setup that is in my trading plan, and not those ones that I don't take. You get? So once we have it like this increases the chance of this one committing to the downside. So this is 1, 2, and these are reversal. Now here again is more like the same thing, where you have price commits to the downside, it forms this hook point. Now you are going to actually mark out this one, which will be the first point. Price push down, it come back up, it creates another one, and then push back down again. You are again going to mark out this one. This will be the 2 point of interest that we're going to be looking out for. Now we don't know if this is the one market is going to react to, and we don't know if this is the one market is going to react to. But what is going to help us is that we are not going to take it right away because price is here in our point of interest. We want a commitment to the downside. From there, we can start looking for our trading plan setup, and if we get it, that's where we are going to engage, considering other variables as well. However, let's say price did not react to this one, and then it comes all the way up to react to this one. Then we can now delete this one, and then we focus on this one, and then the same process repeats. We wait for that commitment, look for our trading plan setups, and then that's where we can engage. Now this one is more like a continuation. These setups is more like a continuation because price is already on the impulsive phase. It creates this footprint or a hook point, and then it comes back down, and then price gravitate towards the area again, and that's where we can start looking for continuation to the downside, probably to take it to this low, because this is the likely area price is going to reverse if it's going to, or maybe perhaps this one, but then there's still going to be a room for us to capitalize on these positions even down to this place. So that's going to be the other one. Now the next one is going to be this one. Now this one is a kind of a different variations of this one because price is still on the impulsive phase. However, it consolidates around this place, a continuation pattern around this place. It come back down, and then it gravitates toward this area, and then we can start looking for the sell. Now what will increase the chance of price actually committing? Let's say if we have a structure, let's say we have this area, and then we have price forming this kind of structures, which is this type of structures into this area, then that will be another high probability, higher chance of price actually committing to the downside from here. Let's say we have something like this. As you can see, we will have 1, 2, 3 ascending structure, which is a reversal into this area. Into this area, again, the same process. We wait for that first commitment. Once we have it, we can now look for entry pattern based on our trading plan, and then we can execute. This structure can actually lead to this place again. Now sometimes this kind of structure, you can still have it within here. Let's say we have this 1, 2, 3 inside this place, so which means we have 1, 2, 3, and we have internal 1, 2, 3. Those kind of stuff actually increase the probability of price still kind of committing to the downside. Like I said, some of the times you might see a value area like this. Let's say you have it like this up here, and then you have this one up here. Now look at that, price actually gap out this area. Now in this type of scenario, can you still take a sell if you see that confirmation based on your trading plan? Yes, but then you have to be very, very specific, because you can take a trade, it will tag you in, then it will take you out for a loss, and then eventually price will come and take out this liquidity, because we are dealing with the liquidities. We are not dealing with this 1, 2, 3 price action. That one is just to give us a perspective of what we have to expect in terms of, okay, it's going to go down. But when we have this type of structure like liquidity areas where price has taken out that liquidity, and we have this kind of structure into that area, that gives us a high chance of price actually coming to the downside. So that is it. Like, we are going to talk about it as we move on. Now this is just a basic idea of the market structure we are going to be looking at for in terms of higher time frame. And then for our entry criterias, we can get that on a higher time frame, and then we can also get that on a lower time frame. Like I said, we are going to be focusing on a continuation, which is going to give us a very, very mechanical approach when it comes to entry setups criteria. Now moving on to the next part, which is going to be our entry setup. Those ones are actually the setups that's in my trading plan, which is something like whichever trade we are going to take on this one, we want every setup to look like that. But this one here is a higher time frame kind of narrative picture. There's going to be a lot of variables that we are going to cover. Like I said, this is going to be a series. So the more we go, the more we kind of treat a lot of variables, and then in terms of the pattern and in terms of market cycle as well. So let's go to the next part. Now the next part, this is actually a setups that's in my trading plan. I only take 2 setups, which is 2 touch and 3 touch. Now these 2 touch have variations, so which is why I classify them into type B entry, and then we have type B plus entry, and we have type A entry, and then we have type A plus entry. Now type A plus entry and type B plus entry is actually more like a higher probability version of our trading plan setups. So which is why once we have those kind of setups and the other conditions are met, believe me, majority of the time they're actually going to play out. So which is why I classify them as type B plus and type A plus, and then we have the ordinary type B and the type A. Now, why type A? Why this one is not type A and this one type B? Now, this one is type A because it has a high kind of higher probability of actually playing out because it's a three touch pattern. We have 1, 2, 3. So this one has a high probability of playing out compared to this one. This one has a more high probability of playing out compared to this one. Now this one has probability of playing out when it's at a certain position. So this one, we're not going to be taking it everywhere. This one is specific. There's a certain locations where we're going to be taking type B setups. You get. But this one, this is a more like a kind of a low risk version of, okay, when price is deep into the run, let's say we are selling and price is down, we would like to be seeing a kind of type A setup, because type A setup, when price is moving to the downside, it gives us a high probability of playing out than those kind of setups. Those ones only works out at the beginning of that move. Let's say we have the value area, then we have the first commitment. When we see a type B setups, they have the high probability of playing out around those zones, which is something we are going to cover again. Now, anything from second or third um, flags or continuation, we would like to be seeing type A because they has high probability of playing out when they are second, third, or even fourth. But these ones, they has a high probability of playing out when they are first or perhaps second. If they are going to be second, then there should be a kind of a 1 hour entry. So you don't want to be taking type B setups on 15 minutes when they are second continuation. But when they are first continuation, you can take them on the 15 minutes or 1 hour. However, this one, you can take them when they are first, you can take them when they are second. But when they are second or third or fourth, again, you want to be sticking to 1 hour, which is what we are going to be covering 1 hour on this one. We're not going to be going to 15 minutes yet. So we want to understand the basic fundamentals of this price action. From there, we can move on to 15-minute entry when during the phase 2 of this series. So now going to the next part, which is going to be entry signal, or call it confirmation, when it comes to candlesticks, so to speak. Now, if we suppose we are looking for sell, we want to see a kind of candlestick formation like this for us to take a sell. This one we call it a retrace. So we want, let's say this is a point of interest. We have this bull candle and it closes here. We want the next bear candle to close at least 50% or more than 50% of this bullish candle. So we can measure it with this tool. As you can see, that is over 50%, or sometimes 50% is okay. Let's say it's here around 50%. We can still take the trade once it's 50% or and above. The minimum, it has to be 50%. We call this one a high test, which we know as pin bar. So once we see it like this, now we want this kind of high test to be piercing through our value areas. We don't want it to be something like this. We don't want it to be kind of, excuse me. Okay, don't worry, we're going to choose that. We don't want this wick to be something like, let's say the wick will be kind of something like this. No, we don't want the wick to be something like this. We want the wick to be piercing through the price to our point of interest. Then we can take that trade. Because if it's trading towards that area, let's say it is something like this. Let's say this is the wick and the kind of the head is around this area. There's high chance of price filling those wicks before it commits. But if, for example, it's actually piercing those areas, which means it has washed orders or taking out liquidities around these areas, then we can now look for the sell. Now the third one is going to be an engulfing candle. This one is a retrace, this one is a high test, and this one is an engulfing candle, where you have the bullish candle and then you have this one completely overcoming the bullish candle. Sometimes they might be equal, which is still okay if they are equal, or if they completely overshadow that one. In this type of scenario, it is better to play a more kind of 50%, taking it around this 50%, because once you have it like this, for example, on the 1 hour, the risk reward is not going to be that favorable for you. You might get 3%, 3 RR, all this kind of stuff. But those 3 RR, you figure out that if you suppose you take a kind of 50% limit order, you would have make up to 5 or 6% from the trade. But because you take this entry on the around here, then it's going to be like maybe 3 or sometimes even 2.5, which is not kind of something you want to be taking. At least 3, 5, and those three should be a kind of a very very quick one. You don't want to be taking a trade, then it will spend like up to 4 days or 3 days, and then you are going to be, you only make 3% out of those positions. No, you don't want that. If you're going to be taking 3%, then it should be a kind of a day, maximum a day or two. That is okay, but anything beyond that, and this one is going to give us that kind of risk reward. Now this is the bullish version. It's still the same thing, but this one is the bullish version of what we just explained. So now what we are going to do next is go through the chart, and then we're going to draw the market structure. This one is more like a back test, but we call this one a chart walk, and then we'll see how we can draw those patterns and everything down to 1 hour, from daily down to 1 hour, which is our entry, and then we can be taking some trades around there. Then once we have familiarized ourselves with the concept and the strategy, then after a few episodes, we can now transition to phase 2, which is going to be backtesting. We are going to use a tool, a backtesting software that's going to aid us through the journey